Ladies and gentlemen, welcome back to the channel. So we're going to do really three things in this video. First and foremost, I will share 6 reasons why I'm bullish on the broader markets heading into the end of this year, into 2026. We will highlight some of the risk factors as well, because there is always going to be risk factors, even when a setup looks really good. So I want to make sure we're all on the same page there. And there's 5 reasons why I'm specifically bullish on Tesla stock throughout the end of this year and into 2026. But again, we will speak on the short-term risks for Tesla and what I see around Tesla's earnings. And third, we do have a clip from CNBC I want to share with you. It says, expect a summer rally into the 6,500s before a shallow correction in the fall. Now, he says this market looks like 2018 in the sense of we had, trade issues, right? Kind of the same economic backdrop. There was concerns heading into 2019 about a potential recession. There is a lot of parallels between now and 2018. In 2018, we saw a shallow fall in markets in the first quarter. Markets rallied to new all-time highs, and then you saw a larger crash that actually went into Christmas Eve, and then you recovered afterwards, okay? He says he thinks the opposite is going to happen this time around. We've seen the large crash in the first quarter, and we could be due for a correction in the fall. And I think he's a very smart individual. Like, this dude's pretty sharp. So I think you should hear this as well. So before we get into all of this information, you already know the deal. Hit that like button and subscribe to the channel if you have not done so already. Now, if you guys have not checked out the trading community, check that out as well. What we are doing over there is looking for the next high-flying AI stock, biopharma stocks, before they actually get, to a well-known place, okay? I invested in Nebius at $17 before anyone knew about it. Today, it's in the 50s, okay, or pretty close to that. I invested in Novartis Semiconductors in the $2 range before anyone knew about it, before the partnership with NVIDIA. Now it's $7. I invested in IONQ at $7 before people really were talking about it. Now it's in the 40s. Invested in HIMS in the 20s, stocks in the 60s, or at least it was. Apply Digital, invested in that in the $3 range. Now it's in the 15s, all within the last 6 to 8 months. Okay. We invested even in Palantir, the IPO day, although I didn't hold that long enough. We bought Ethereum at $300, even though I did not hold that long enough. We are early to things, tend to always be early. And the idea is to give these investments time to work. Okay, so there's 6, 12, 18, 24-month time horizons, sometimes longer than that. They can turn into longer-term investments as well. Check out that link down below in the description of this video. There is no other trading community like this. Yes, we do short-term trades, but that is not the main focus. The main focus is really finding those quality stocks, reducing the risk profile of the portfolio by finding the quality names, and, letting them turn into 10, 20, 30, 40, 50 baggers is the idea. Obviously, read the disclaimers. I'm not a financial advisor. I'm not a financial planner, blah, blah, blah. You take risk when you invest, and verify all DD. That is the sponsor of this video. With that said, let's go ahead and start off first and foremost with the 6 reasons why I'm bullish on broader markets heading into 2026, because there's really something we have to establish with Tesla, okay? Tesla is a stock in the markets. We understand that, okay? What happens in the broader markets can either help or hurt Tesla, no matter what's going on with Tesla, okay? If Tesla's doing poorly and the markets are doing poorly, well, the stock's going to do even worse. If Tesla's doing poorly but the markets are doing well, that is kind of a support. And if Tesla's doing well and the markets are doing well, that is a very positive setup. And I actually think that is the setup that we are heading for over the next 12, 18, 24 months, okay? I think there's going to be an AI super cycle, but we'll get to that in just a moment. First and foremost, and these are not in order of importance, you have geopolitical conflict that is gone, okay? essentially gone. There's not really any major conflicts out there besides the war in Ukraine, in which I think markets are long over that. Okay, so geopolitical conflict ramped up and is now essentially gone. Now, the tax bill deficits and will help lower income consumers. Okay, so deficits long term threaten the sustainability and really country. Okay, they're not great long term. In the short term, they are stimulative. Okay, by short term, I mean the next couple of years. Okay, so that's one reason why markets are at new all-time highs, is because the bond market is saying we'll be able to grow to match the debt. It's not a huge problem. Okay, that's why yields are not 6, 7, 8, 9, 10% right now on the 10-year Treasury. Okay, when and if America does not grow fast enough, if the debt does become an issue, long duration yields are going to skyrocket. We're going to have a recession, borderline depression. Like, it'll be terrible in the process of America going bankrupt. Okay, but the bond market is saying this bill is not going to do that. So the deficit is stimulative. Okay, now there's aspects of the big beautiful bill, some of the tax policies, that are very positive for the lower income consumer. Let me read you a little bit of a stat here. And this is a stat that has held with me since I heard it a couple of months ago. So spending in the economy, it's not even. Okay, today, about 50% of the spending in the economy comes from the top 20% of income earners. So the top 20% of income earners account for 50% of all dollars spent in the economy. 10 years ago, 15, 20 years ago, it was only 30%. So you've seen the lower income consumer just get worse over time. And especially in the last couple of years, this has really sped up. I believe, 2019, it was like 37% of spending was from the top 20% of households. Now it's 50%. Partially that's because lower income consumers do not spend as much anymore. Okay, they've been in a recession for a while. Now there's 60 to 80 million Americans that rely on tips for their income, whether that's DoorDash, restaurants, other service industries. Okay, that's a lot of people. Well, the no tax on tips up to $25,000 actually relieves about a $5,000 to $6,000 tax burden up to $25,000. Okay, so that is a lot of extra money that people will be able to spend. No tax on overtime up to $14,500. I've not done the actual calculation on that, but that's going to save an additional couple of $1,000s. So on the higher end range, you're looking at $8,000, $9,000, guesstimating here, of tax savings that somebody could save. Okay, on the lower income spectrum. There's obviously income thresholds, but mainly for lower income that tend to be tipped workers. Okay. At minimum, you're probably looking at like $5,000 per person. That's substantial. Okay, I think that can really help the lower income consumer get back on their feet a little bit and not struggle as much, which would be great. Number 3, I don't think we're going to have inflation. We've talked about this extensively here on this channel. If there's one thing you need to know about tariffs and about inflation for the rest of your life, inflation is only ever a monetary phenomena. So Trump's deficits, that is a monetary phenomena, okay? Technically fiscal, but deficits are money, okay? Excess debt issuance. The government does not print money. They issue debt. Once they sell the debt, then they print money. So deficits just mean that's how much extra money the government is going to have to sell in debt, aka then print, that will be in circulation. So if anything can cause inflation, it's the deficit. Now, in a capitalistic economy, we tend to have a lot of competition and innovation. I've talked about this before, just to kind of, again, use the reference. I had a shoe on in the previous video, but say this hat for an example. If this hat is $50 and goes up to $60, okay, fine. You may or may not buy that. If this identical hat made by a different company is offered at $40, you're always going to choose the $40 hat that is identical over the other hat, okay? That's why companies will not be able to raise prices from tariffs, because it will not be even, Not all companies will feel the tariff pressure. If this hat is made in China, then maybe, Nike or whatever will feel the tariff pressure and feel the need to raise prices. But if this hat is made by another company in America that can undercut and do it for cheaper, Nike will lose market share. That is way worse long term for your business than what a small hit on margins would be. Okay, so kind of like TVs, right? TVs have gotten bigger and better and cheaper. That's because there's a lot of competition. Okay, if you want to come out with $1,000 50-inch TV right now, that is of similar quality of a 50-inch TV that's $350, you're not going to sell many TVs. Okay, you're not going to survive as a company. Okay, that's why in a capitalistic world you only get inflation via excess money supply. And really, in recent history, we've only seen inflation not from deficits. We've run deficits for a long time, but from when you actually give out like stimulus checks, when they are unneeded, when you flood the consumer with stimulus. Again, using this hat as an example, if you got $1,000 a week for the next 52 weeks of additional income, this like some of the unemployment benefits were back in the COVID days, buying this hat at $60 versus $50 may not like break the bank, right? But today, when people don't have extra money, when there's a vast cohort of the economy in a recession currently, people don't look at price increases the same way. When all companies were raising prices, like during 2020, 2021, what could you do? Like everyone was raising prices because of what was going on at the time. Today, it's not like that. And the argument is you're going to see a wage price spiral where tariff companies raise prices and then consumers ask for wage hikes. I actually did a poll on X over the last day. Go respond to it before it closes. But I asked people if you could go to your boss right now and ask for a pay raise because of tariffs. And guess what the responses were? Okay. The response was 1.9% of you said yes. Okay. Only 1.9%. 69.2% said no. 9.6% said maybe. And 19.2% of you guys said I'd get fired. This is a much different economy than the 1970s, where it was a lot of manufacturing. There was really no like software out there. This was 55 years ago, almost 56 years ago. Like software, internet, that like wasn't even a thing then. Okay. These days, you can be easily replaced in most jobs. Okay. And I think AI is even a bigger risk to that as well. So it's not like 2020 where everyone can go and get wage hikes because prices are going up on everything. You're not going to see sustained inflation from tariffs. There will be no inflation by the end of this year. That's the fact. The sooner you guys realize that, the better off you will be in your investing journey, because then you can exclude this inflation threat or perceived inflation threat as a non-issue. Once you take out like Wall Street's fear of inflation at this current moment, I think people on Wall Street would be a lot more bullish on this market. Like if there was no inflation, no tariffs, I think, people would be a lot more bullish, right? That's the upside. People are bearish now and they will turn bullish and buy more stock, right? That's where you get the upside from this point. So that is why number 3 is no inflation. And that's a reason to be bullish in 2026. Number 4, I think we avoid a recession. Now, tariffs, they're not inflationary, but they do hurt growth, okay? They do. Because if Nike, for an example, again, with this hat, and I know Nike doesn't make this hat, but we're just going with it. If Nike does see the margin hit from tariffs, and they do need to raise prices, okay, well, they can't really raise prices because of competition, because of capitalism, okay? What Nike can do is keep prices the same on this hat to be competitive, but they can look internally at their business and fire people. They can look internally at their business, become more efficient in operations. The Keynesian approach, taking small steps to equal a large result. If you don't know what Keynesian approach is or Keynesian economics, check it out. It's from Japan. Toyota is infamous for using this, taking little things and doing them repetitively to equal a big result, right? That could be becoming more efficient, a couple dollars on each shipment or a couple $100 on each shipment. It does add up, right? The small things add up, even in your personal life. That 10 minutes, exercise adds up. That 10 minutes of reading a book every day adds up. 10 minutes of looking into stocks and learning about markets adds up, okay? Same is true with businesses when they look to be more efficient, okay? I think it's also a big use case driver for AI. I think a lot of AI programs can also help, offset some of maybe that margin hit from tariffs. Or you can fire people. And that is obviously the most disinflationary thing you can have happen. If people lose their jobs, they can't spend money, there can't be inflation. Okay. So I think we will avoid a recession, but if tariffs do hit, it's more of an issue on growth than it is on inflation. Number 5, we get a new Fed chair and 8 to 10 cuts next year. Assuming we avoid a recession, we don't have inflation, we have all of the other positive things going on. If we get a new Fed chair that cuts 8 to 10 times within the next 18 months, which is probably roughly what we're going to see, 8 cuts would be about a 2% reduction in the, federal funds rate, which would take it down to about 2.5%, which is probably where we should be right now. Okay, 10 cuts, could you go down to 2% on the federal funds rate? Yes, that could happen. Okay, as long as we are avoiding a recession and we don't have these other issues like inflation, 8 to 10 cuts would be seen as very positive. The reason for cuts is more important than cuts itself. If the Fed is cutting because the economy is weakening, that's not a good rate cut. If the Fed is cutting because the economy is okay and we don't have inflation, that is a good rate cut. Keep that in mind. Number 6, I think an AI supercycle is coming as adoption picks up. I think adoption of AI is only going in one direction. It's only going to go up from here. And I think 2026, as we get looser monetary policy, as all of these other things come to fruition, I think the focus is going to be on AI. The focus right now from Wall Street, some people are focused on the economy and whether we're going to go into a recession or not. They're focused on inflation and what the Fed's going to do. Once you exclude all of that, I think the big focus is on the next big revolution for the economy and for the world, and that is AI. I also would add to this that we are in a Cold War with China, okay, with AI. There is no room to slow down on AI innovation. And, these are the companies that we're looking for in the trading group that are largely undiscovered, that are doing big things with AI. I think that is where a lot of the opportunity and potential is in this market. So as in just broader economic backdrop and markets, I see positive things, very positive things coming over the next 12, 18, 24 months. Really, I think AI is going to be here for the next decade or two as a main thesis in markets. There's going to be other things that branch off from AI. Maybe there's periods of robotaxi products being hot on Wall Street, flying taxis, or the next software company, or the next chip company that takes on NVIDIA, right? There's going to be different waves of this, but I think AI as a general theme is here to stay for a very long time. Now, 5 reasons to be bullish on Tesla. Again, for 2026, for this year in 2026. Number 1, the Model 2 is still coming. I think right now there's about 50% of Wall Street that thinks it's still coming and 50% of Wall Street that thinks Tesla's focused on AI, that it's not coming. I think the launch in the Indian market shows that the Model 2 is still coming because you're not going to sell that many Model 3s and Model Ys in India. You need a cheaper vehicle. Okay, so that's number 1. Number 2, market has not realized the AI potential. Okay, this is pretty obvious, and I think it's pretty rare for a company to be $1 trillion company. And we can sit here and say, Wall Street has not realized this yet. Like, you're not going to say that with NVIDIA or Apple or Microsoft or Google or any of the other large companies. This is something that I would say is like a main bull thesis in a small cap AI company. Like, Wall Street has not realized the AI potential. because they don't know about it, right? It's weird and unusual that Wall Street does not realize the massive AI potential that Tesla has. If they did, I think Tesla would be a $2 trillion company right now. It would be a $600+ stock, and that's why I think Tesla can hit $600 by the end of this year, if not early 2026. Number 3, kind of tying into number 2, Robotaxi. I believe expanding to 5,000 plus units next year. Wall Street is probably at 200 to 300 expected, okay? Wall Street probably thinks only a couple hundred robotaxis will be operational next year in a couple cities. This upcoming earnings, Elon could say, hey, we're expecting thousands of robotaxis next year. In fact, I think by the end of this year, Tesla may start doing, third-party robotaxi services, like letting you turn on your Tesla, use the Tesla platform to conduct robotaxi rides with your own vehicle, with hardware 4, obviously. And Wall Street is just nowhere near what the guidance that we're probably going to get on this upcoming earnings. That is really what I'm bullish on in the near term for Tesla, is the robotaxi guidance, number 1, and number 2, that the Model 2 is still coming. Okay. Number 4, Optimus is not dead. There's been reports recently, even today, that some officials that have been working on Optimus have left the company. I think, again, that fear is far overblown. I really see Optimus long-term as a necessity, not an option, right? What I mean by that is 20, 30 years from now, there's going to be a real deficit of workers, of people. There's already a deficit, but it's only going to get larger over time. And the jobs that people don't want to do today are going to be even harder to fill in the future. You're going to need robots because why? People are not having children. 50 years ago, the average family size was 5.5 kids. Okay. Today, it's 2.5. And for the first time ever, women over 30, there's more women over 30 that don't have kids than women, under 30 that do have kids. So people are just waiting longer to have kids. They're having less kids. And you're not going to feel this right now as much. But 20 years from now, it's going to be an even bigger problem. Even 10 years from now, you're going to start to see the real issue arising from this. Japan went through this when they had a baby boom in the 70s, 80s, 90s, whereas now they're having a lot less kids. 20, 30 years passes, and there's not enough people to fill positions, and there's a lot of people getting older, okay? You're going to be in a Japan-style situation in the U.S. 20, 30 years from now. And robots, it's not going to be an option. You're going to need them to fill some of the positions. Okay. Number 5, Elon's new comp plan will bring a new Elon Musk. This is very important to understand. Elon is very much not incentivized to say anything bullish about Tesla. I'm surprised Elon does say anything good about Tesla ever, because the board is currently discussing Elon's compensation package. Why would Elon want the stock at $600? He wouldn't, because it makes it harder for him to reach the tiers of his compensation package, right? If the stock is $1 trillion company and the first tier of his compensation package is bringing that up to $2 trillion, that's great. If you're at $1 trillion, if you're already at $2 trillion, you're not going to get your first payout at $2 trillion, right? That doesn't make any sense. So right now, I think Elon is just doing what he wants. He's saying what he wants. He's being politically polarizing. He has no incentive whatsoever to be aligned with shareholders. Once Elon's new comp plan does come about, which could be this earnings, I lean towards probably not. But by November 6th, the shareholder meeting, Elon's compensation package will be announced and will be voted on and put into effect. It may be voted on in like October or something and then implemented on November 6th. I'm not sure the exact, runway here for that. But by the end of this year, you will have a quote unquote new Elon Musk that actually works in the favor of shareholders, that has his interest aligned with yours. He hasn't got paid from Tesla in like 6 years, right? There's no alignment here. Besides, Elon wants, to grow his ownership in Tesla eventually. But as of now, no matter what he says or does, positive or negative, does anything to help or hurt him. Okay? you could obviously, I guess he could hurt, his plans if he like created so much damage to Tesla they got a new CEO or something. But I think you will see a new Elon that really does not pump Tesla, but doesn't say as many negative things that could hurt Tesla. Really becomes aligned with shareholders, which is an Elon Musk that you currently do not have. So when I view this, I see in the short term, it's about inflation. It's about growth in the economy from a broader perspective. By the end of this year, that's going to be over with. And by 2026, I think we're not going to have those problems. Wall Street's not going to be focusing on that. They're going to be focusing on AI innovation and what's coming next, for earnings ultimately. In the short term, I see Elon's comp package probably taking a couple of months. I think earnings are going to be a very positive event where Wall Street is surprised by the plans for scalability of robotaxi. And I do see some pretty dramatic upside as a possibility following earnings. You could see Tesla stock going into the 400s. Now, I think it's the comp plan, the combination of the broader market backdrop improving by the end of this year. Again, no inflation, economy that holds up, that does not go into recession, that helps push a end of the year rally, into the 600s for Tesla. That's when Wall Street finally will start to realize the AI potential that Tesla has here and the total addressable market that is virtually unlimited. When you think about robotaxi, when you think about energy products, Elon himself has said just the energy division is pretty much unlimited as far as growth. Obviously Optimus, right? So that's kind of my expectation. While it's really hard to say in the very near term, I do think following earnings, we will get a positive result. Tesla tends to sell off right before earnings, so don't be surprised if that, happens again. Okay, right before earnings, literally like every time you get a sell-off a couple days before Tesla earnings, a week or two before, literally every time, like clockwork, right? Besides rare instances, but the last couple of years, it's been pretty much the same story. Most of the time, at least kind of recently, you've been able to do well after earnings, right? Last earnings, Tesla did well after earnings. The one before, it sold off after earnings, and the one before, it was right after the election. And obviously, Tesla stock did very well following that earnings. So out of the last 3 earnings, Tesla sold off once after and went up dramatically twice after. So we'll see if it can go up again, but I do think it will. Now, I'm in the process of putting together my full piece of due diligence on Tesla, long-term and for the short term. I will also be sharing my positioning in Tesla. Yes, Tesla is my largest position in my portfolio. It's not my only position in the portfolio. If you guys want to see all of that, check out the link down below in the description of this video for the trading community. Now let's get into this short clip on CNBC about why markets could power into the 6,500 range by summer and why this one analyst believes you will see an end of the year correction. I actually think the markets are going to hit 700 this year on the SPY. I've been saying that for a while. That continues to be my view.
With the market sitting near record highs, the big question, of course, is where are we headed from here? Let's ask B of A's Paul Ciana. He is head of the firm's fixed income, currency, commodities, and equity technical research. Good to see you, Paul. Good to be here. A lot on your plate. Huh? Yeah, exactly. FIC is fine. Yeah. S&P 500, we've obviously broken out. You've had like 8 record highs this year. Yep. New highs, I guess, tend to be more of a positive sign than not. But where are we in terms of maybe this rally being exhausted or leading to more upside?
Sure. Well, there's always an overbought market somewhere. And yes, the S&P 500 is getting a bit overbought. And we're seeing signs of tactical weakness, but that's okay. We're also seeing plenty of signs for a bullish trend. If we think back to May, when we initiated our bullish outlook for this summer, we had that very nice head and shoulders bottom in the daily chart of the S&P 500. That, like the technical textbooks would say, measures up to about 66.25. Okay. So we've been looking for a rally into the 6,500s this summer, maybe with a little upside risk to that.
And should we be bracing for any consequential pullback along the way here? I mean, we've had nice rotation this week that's kept the overall indexes in place.
We have good rotation. I think keep an eye on the Dow Jones Industrial Average and the all-time high level at about 45,000. If you want to see more rotation, we need Papa Dow to break out.
Okay.
Another thing to look at and favoring the breadth narrative is the percentage of stocks above the 200-day moving average has trended to higher highs with the S&P 500 going to higher highs. So there is some growing breadth within the space. What I think scares me a little bit or intimidates me a little bit is the 2018 narrative. So in technicals, we like to say that the rule of alternation occurs with corrections. And there are a lot of parallels between 2025 markets and macro with 2018. In 2018, we had that shallow correction in the first half, big rally to all-time highs, and deep correction at year end. So I think the rule of alternation suggests we get this rally to new all-time highs, and we have a mean reversion towards year-end. Okay. So maybe if we get up to 65, 6,600 towards year-end, maybe we come back down towards 6,200.
So in other words, the inversion means we got the big correction early this year.
Right.
And it would be a more modest one later on.
Exactly.
I got you.
Yep.
In terms of some individual leading stocks, Uber is one that you've focused on. It's been fascinating to me. One, it's in the industrial sector. It's been a big source of upside there, and obviously it's got other attributes as well. How's it set up?
I mean, the Uber chart's amazing, right? 2022 to 2023, very nice uptrend, and then 24 to 25, you had this broadening out and then contraction. Right? And that's an awesome technical pattern that really represents confusion in the fundamental space. And as you start to contract, we started to get the breakout to the upside both in price and relative performance to the S&P, and we initiated upside targets of 101 and 113.
Okay.
So I think it's going there.
So basically, the chart's telling you the confusion has been resolved to the upside to some degree?
Absolutely.
Want to get your take on the dollar. Obviously been persistent weakness, but then for some bounces along the way here, in fact, recently as well.
Yeah. Well, the dollar index hit about 110 in February. Euro is down at 102. We caught the bottom in the euro and the peak there. And it's come screaming lower. Bad year for the dollar to secular trendline support. So I'm telling all traders and investors, keep an eye on the 97 figure even on the dollar index, because while we're above that, there's about 5 reasons why we may see a good Q3 bounce.
Okay.
Aside from secular trendline support, we have bullish divergence from the relative strength index. We have a slew of trend exhaustion signals from the market indicators. We have bearish sentiment, very stretched bearish sentiment from the B of A Global Research Fund Manager surveys and FX and rate sentiment surveys. Asset managers are stretched short to like record extremes. So one really good data print, for example, could just create that Q3 seasonal dollar strength, which is another reason. Seasonally speaking, Q3 is a good quarter for the dollar.
It's kind of wound tight. Yeah, I guess that makes sense. And then just quickly, you mentioned, watch the Dow for signs that, we have a little more upside. You say 45,000. That's 600 points up from here.
Yep.
How soon does that have to happen? Does it matter?
Not really.
No.
Sooner is better.
Right.
It makes it easier to stick with it.
Sure.
But look, last week, Dow had a great rally right up to the figure. This week, a little pause.
Sure.
It's all right. It'll go.
Give it a little room. All right. Appreciate it, Paul.
Thank you.
Good to talk to you.
And with that, let me know your thoughts on all of this down below in the comment section. Have a great rest of your day, and I will see you in the next one.